Good afternoon, everyone. Welcome to this special transfer pricing hangout by Taxsutra Team. I'm joined by well-known transfer pricing experts, Mr. Vijay Iyer, Head of Transfer Pricing at EY. Vijay is joining us from Delhi. We are also joined by Vishweshwar Mudigonda, who heads the transfer pricing at Deloitte. Vish is joining us from Bangalore. I'm also joined by my colleague Swapna Marathe. She is a deputy editor at Taxsutra's transfer pricing portal. Welcome to all of you for this special hangout. What a day! It's been 24 hours since Finance Minister presented his budget, and the budget has largely received a positive response. But in the fine print, several issues, several points to ponder over, which will keep and the businesses sort of engaged for next few weeks. We've named this budget coverage as will FM Jaitley be able to and quick opening comments first from Vijay and then Vish. Do you think that Arjuna was successful this time?
Thanks, Amaya, and welcome everyone. So when we look at the budget, usually, transfer pricing doesn't figure too much there. So we have a relatively easier day. But this time, whatever has happened, it's not too many. There are a few changes, but the few changes are so huge that, to be honest, I have not been able to figure out what is the impact on a lot of my clients right now. And it would impact a lot of them. So it is something which is critical. And whether this is the right time for us to move on to some of these changes, that is debatable. But whatever has been done seems to be thought through, and he seems to have given it a good thought before he has come up with some of this. So it looks like transfer pricing was on his agenda, and it's good news for us.
And on an overall basis, what's your take on?
Yeah, so honestly, when I was looking at the actual fine print of the budget, unlike most years where there is a lot of talking points, this year was less on that. I think there was more focus on the expenditure part to make sure that what you collect you apply appropriately. So the song and dance was much less, which is good because it was much more serious stuff and limited but serious. I think from that point of view, it seems to be a very conscious and not to rake up too many issues and not to create a whole lot of noise around it. So particularly happy with that fact.
Vish, do you think Arjuna was successful in breaking Chakravyuha this time?
Well, first of all, good afternoon, everyone. I think if you look at the budget, there is definitely a very focused approach on some of the key issues beyond tax. If you look at whether it is infrastructure or those 10 focus areas, I think that brings a lot of focus, which is much needed. And I agree with Vijay. In fact, I was just thinking that everything that has to be done in transfer pricing, by and large, has been done. And when all the BEPS action plans in one way or the other brought down to with CBC and all brought on to into the Finance Act, I thought we may not see too much of action. But one I was actually hoping, and in my pre-budget expectation, I wrote as a correlative adjustment post the Instrumentarium Corporation ruling. But it was a googly actually. If you look at, instead of correlative adjustment, we brought the secondary adjustment, which is basically legitimacy to whatever the authorities, whether at the MAP discussions or during the APA discussions, they have been saying that okay, you have to bring in this money. So and to an extent, it is also supporting what the officers have done in the context of Vodafone, though the primary adjustment was deleted completely. I think on the secondary adjustment, if you see, treating that as a loan, I think that's on transfer pricing. But overall, I think it's a good, though perhaps when you look at post demonetization, what will happen, and there were a lot of expectations around the digital India and the initiatives around that. He tried addressing most of those. but maybe I do not know. If you look at an economist and ask him what it is, probably he'll say it is falling short of Big Bang reforms.
Right, right. Both of you touched upon the secondary adjustment, and that clearly is a bit of a surprise and raises several issues. I request my colleague Swapna to quickly take us through the key highlights of this particular proposal around secondary adjustment, and then we'll debate some of the issues that arise from it. Swapna?
Yes, Amaya. I will explain the provision. Now, the Finance Bill is proposing to introduce new section, which is section 92CE. I will explain the secondary adjustment provision with an example. If there is a transaction between Indian entity and foreign entity, say sale of some goods of ₹100, and the ALP is determined at ₹120, the amount of addition, that is 20 rupees, if it is not received in India or repatriated to India by a foreign entity, that amount would be treated as if it is a loan given to a foreign entity. And what really the bill is proposing is to assess a notional interest on that loan, presumed loan amount in the hands of Indian entity. Of course, but the provision is not applicable in every single situation. They have listed out 4 situations, typically related to basically the conditions where the assessee has accepted the transfer passing adjustment. Either in the transfer passing adjustment made by AO has been accepted in assessment, or there is under the APA or MAP proceedings, or under safe harbor rule. In that case, condition only this particular provision would be triggered. They have also provided certain exceptions. If the adjustment amount is less than 1 crore and the adjustment pertains to year prior to AY 1718, in that case, this provision won't be applicable.
Right. Vijay, a very interesting provision. First, quick comments. Is this word proposal in line with the global best practice, and any one or two key issues that you think will sort of haunt the taxpayers going forward?
So yeah, we have selective countries which have this. So it is not as if India is the first one trying to do this. So countries do have the concept of secondary adjustment. The mechanism of how you treat that, I think that there is a debate around it as to whether you treat this as a deemed dividend or you treat this as a loan. So there are different views around it, and I think the loan option has not been exercised internationally as much. You would find more around the deemed dividend concept. But it is not unusual. But when we had the TP introduced in 2001, the Rajnarayan committee, which had initially come up with the guidance and the white paper on transfer pricing, they had suggested that India should not move on to secondary adjustment. But maybe, 16 years down the line, maybe you can't still latch on to that same statement. So maybe it is time for people to look ahead and think of something different. So in that sense, I don't think we have a persuasive argument to request the government not to have this at all. The impact for taxpayers clearly is that while for most taxpayers, I think they are still in the arm's length bracket and they would still want to fight out and still argue that they are in the arm's length, so they should be okay. But some of the others who really, if you look at the way international concept on dispute resolution works in transfer pricing, you would find that most companies want some kind of a settlement mechanism. Now, that settlement option, saying that either I give up my claim for litigation and I accept the AO's order or the TPO's order, that option now seems to become more expensive because apart from having to pay the tax, you also need to bring the money in. So in some sense, the thought of taxpayers wanting to settle or accept a particular adjustment will have to keep the overall cost in mind, which will basically be an additional interest cost over
Right.
the tax cost.
Right. Which the secondary adjustment essentially sort of mandates bringing the money back into the country. Could you take this thought forward, and if you look at the companies, MNCs, how exactly this will pan out? Meaning, you will do a transfer pricing study, your assessment will happen a couple of years down the line. Of course, the presumption over here is that taxpayer accepts it, as Vijay mentioned. but bringing the money into the books after a few years, do you anticipate challenges on this aspect?
Uh, I think if you look at largely, let me step back and look at what is the printer's devil, or it is a thought through process. I really do not know, but I noticed something, and I would be happy to hear Vijay's views also on this. If you look at the effective date of this particular provision is going to be the assessment year beginning 1st April 2018. That is for 18-19 assessment year onwards, this is applicable. And when you look at the exception that is carved out, it talks about the 1 crore and any adjustment made on or I think the wording is 1st April 2016. It means it is the adjustments made up to 17 assessment year will not fall under this purview, and they get out of the purview if it is 1 crore and more.
Right.
But the point is, what happens to the year in between? That is 17-18 assessment year. So you have the provision from 18-19 onwards, and it is talking about the adjustments 16-17 up to 16-17 assessment. So 17-18, is it a printer's devil, or is it something that is beyond what means now? So that's the first technical issue which I could not really understand what the logic is.
Which, if I may pause you on here, and Vijay, any quick comments on this point on the effective date before we goes into the money bringing the actual remittance part?
Yeah, so there are two dates in the section. One talks about the effective date, which is from a financial point of view, April 1, 17. April 1, 17 is the start of the assessment year, the specific assessment year where it's covered. Now, that is one date. The other date is with reference to April 1, 16. And that, when you look at the drafting of that, there is obviously an interpretation which can be quite damaging. So whatever is the applicability of that, the proviso, the way it will be looked at is for any activity happening after April 1, 17. So after April 1, 17, if I were to accept an assessment in respect of a past year, then this would kick in. Maybe that's the way to interpret it because of the way it is drafted. Ideally,
so is financial year, right?
Financial year, yeah. Financial year, April 1, 17. After April 1, 17, if I were to do any activity out of those 5 specified activities, maybe there is a map settlement, maybe there is an APA, I conclude and I do a modified return. So that interpretation is very damaging and dangerous. But that is how it reads. So my hope is that it is a drafting error, and it should be only transactions after April 1, 16 should get covered. So that proviso drafting needs to be looked at again. And if I say that after April 1, 16, which means that for any transactions for April 1, 16 onwards, if I were to file a tax return in November 17 and I am doing an out-of-book adjustment, I need to take cognizance of this. So any tax return that I do now, I should take cognizance. But any past year assessment where there is some activity of a map settlement or an APA or a assessment that I accept, it should be outside the purview. But the current drafting seems to bring that also in to say that if it is more than 1 crore and it is so then that more or less satisfies. If it's more than 1 crore and is of a period prior to April 1, 16, then that should be okay. So that I would believe is the way it is reading, but probably that's not the intent.
Also, Ameya, it uses the word "and," so which means for this provision to have an
apply. Yeah.
Apply both. So if it is more than 1 crore,
yeah,
but if it pertains to earlier year,
it will
what's
apply.
going to happen?
Yes. So that and does create that problem.
So it will have much wider implication than what it looks like a very simple provision, and he has carved out some exception, but it looks like it is a minor exception, and there within that there is a confusion.
So it's convenient for us to, talk about the drafting error, but we have a real life client situation who has to do an auto book adjustment in the next 2 days. So we have to take a call. It is in respect of a past year. He is voluntarily revising his tax return. It is within the revision time frame. And now he's asking that, what should I do? So it is a challenge, but my guess would be that I would hope that the drafting error would change and the and would be changed to or. In which case, if it is in respect of a year prior to April 116, it should not require anything else. You just pay the tax and be happy with that.
Yeah, clearly the 1st February date this time for presenting budget helps in this case. Hopefully, we will have an answer before March year end itself.
Yes.
Yeah, Vish, on the secondary adjustment and the mechanics around it.
I think if you look at largely, let's take under each of these scenarios what's happening on the ground. Let me take safe harbor rule first, because that is the most simplest of all. Because once a taxpayer is deciding that he is actually applying a particular principle, while there was an ambiguity and no one was providing a clear guidance as to what should be done, but largely the very few cases which have gone under safe harbor, at least the ones I know, have actually made changes to their intercompany agreements and brought in that money. In case of APA, we have been seeing, even in the context of rollout, the agreements are very categorically saying that the money has to be brought in. And so therefore, there is no ambiguity there. The third is MAP. MAP, again, from US perspective, as you know, if they don't pass these entries in the books and create a receivable or payable, and then settle that, it will be treated as dividend in the terms of which Vijay has alluded. So therefore, in all these three cases, they're largely very less of a problem. But I think where the assessments are concluded, again, if you look at the litigation trends, 70% of these adjustments are not getting confirmed. So in those cases, you will have a challenge where this will reach finality after a certain point in time. Then at that time, typically you are accepting, and even if you are passing an entry in the books, so whether the inputs will apply from retrospective or from the time I have accepted. I think ideally it should be from the time I have accepted. So I guess just taking the transfer pricing adjustment to a logical end, and also in a way they are creating a recurring issue for the taxpayer. So if someone decides not to get this money for whatever reasons, perennially, year after year, they will be paying, they will at least have to get a notional interest. And what happens to that notional interest? These are a few challenges. I think in the course of time, as Vijay said, when we have more of practical examples and you get into the real life situations, you will have more fights. But I think to a large extent, the companies are now taking cue from what has happened in the context of APA and MAP. Companies are reconciled to make these adjustments and put those amounts in the books.
Right. Right. Vijay, continuing this point further, if you look at the way the definition of primary adjustment and secondary adjustment is worded, it somewhere says that adjustment should be made in the books of the taxpayer as well as its associated enterprise. Obviously, Indian law cannot have a implication on what adjustment is made in the hands of the associated enterprise. Situations or issues might arise as to which associated enterprise, when you're using a transaction-wide TNMM, entity-wide TNMM method, which entity should sort of give an effect to the secondary adjustment. Any thoughts on some of these issues, Vijay?
So clearly, I think that on the second point, which AE, the law is very clear that each AE who is involved in the transaction where there is a shortfall has to compensate, which is a problem because I may have AEs in, let's say, Africa or Southeast Asia where There may be exchange controls. I can't raise a supplementary invoice. There may be lots of issues around how do I actually comply. And maybe that's a representation we can make to the government to say that so long as it comes, you shouldn't care whether it comes from A or B. So long as the adjustment amount comes, you should be happy with it. So there should not be a one-to-one correlation between an AE and the remittance. The second is the entry in the books of accounts. So this particular amendment presupposes that everyone is bringing the money in. So therefore, there is an entry and there is a receipt. Whereas if you look at it, there are a large number of companies who may either suffer an adjustment, pay the tax, pay the interest, and may have just accepted the litigation. Even they are not invoicing and collecting. And there are companies who are doing out-of-book adjustments in their books in a routine way because they believe that they have a global transfer pricing policy which is arm's length. But because they don't want controversy in India, they would agree to a particular margin and file tax returns accordingly using out-of-book adjustments. So the banking sector, it's quite common. There are lots of banks who would do out-of-book adjustments because they say that we do a proper 50-50 split or a profit split. But I don't have the ability to bring in the books of accounts of my global network to prove to you that it's a pure profit split. So I just do a top up to a TNMM and everyone is happy with that. So some of those issues will arise where you're doing an out-of-book adjustment as to how do you now bring in the money. And there are a lot of instances where the taxpayer does not bring the money in and they are doing safe harbors. So I know of a company which is at cost plus 10, but conveniently pays tax on cost plus 20 because of the safe harbor and says, I don't want the headache. But now, apart from the 10%, you also have to find a way of invoicing and collecting, and which may not be practically possible. So clearly, my view is that the other AE will have to account for it if you're accounting for it. So if you say that I'm going to collect this shortfall of 10%, then I'll book an entry here, and that entry will automatically result in an entry there because I would be raising an invoice. So that I think is resolved. I don't think it's about whether the Indian law extends as far, because once I raise the supplementary invoice, I think I'm done. But there are a lot of instances where I can't raise the supplementary invoice, and especially in that option where you are doing an assessment, you don't really have an option because that assessment happens few years later, and the books may not be available for you to play around with. So clearly, we need to have an option where the remittance is never made. The law needs to consider that as an option, and maybe when they come up with the rules to calculate the interest, they may bring in that clause. So they'll give you a calculation for the interest, and they will say that this can go on till perpetuity if you don't bring the money in, or you could select a dividend-based calculation of interest, which is then a one-time charge. So I would believe that companies, at least in APA, were happy to accept the one-time charge model. Nobody wants to live with a perpetuity. And there will be few companies who will say, given this current situation, I may bring the money in, but that's a choice that they will make. So clearly, I believe that there will be some detail in the rules when it comes out, which will be giving us more answers to some of these problems. But I certainly have clients who would want an option of not to bring the money in and pay the DDT and close it.
Right. So on the secondary adjustment, yeah, sorry, Vish, please go ahead.
Vijay, because see, this is going to create a lot of problems, and also if you look at the regulations of different countries, and some of those countries which Vijay mentioned where there are exchange control regulations, which even India had a few years back, if there is a challenge in remitting the money to India, then it is a fait accompli that perpetually you will have this adjustment. Perhaps it may be a good idea to have the dividend option, though it's a one time, and then it is the taxpayer in the rest, instead of getting into all these of how to account for it, whether to get this or not, how am I going to split. Perhaps even the government would be better off to say, okay, this is treated as deemed dividend and now you pay taxes on this deemed dividend. So once for all it is settled and there is no further dispute, there is no further litigation, you simply get, the government also gets its share of money. And this is what in many of the other countries where secondary adjustment is made is what they do, except a few countries where a loan option is.
Right. Swapna, when we were analyzing this provision, you two noted a few issues. Would you like to ask any of these issues to Vish and Vijay?
Yeah. See, basically, when there is a imputing of interest, that also becomes income of Indian entity. And if in case that exceeds the amount of 1 crore, where there would be a secondary adjustment on secondary adjustment if it is not collected. Is it like a compounding effect? I was wondering.
At least
Vijay?
my reading was that it says that the primary adjustment is what becomes the advance. There is nothing else that becomes advance. So my feeling is that any interest that comes doesn't come within the definition of primary adjustment. So we should be okay there. There may not be a compounding, but it will be a simple interest forever. That's the way I read it.
Vish?
I agree with Vijay. As I said, there is an ambiguity. Once that ambiguity is cleared, you will be able to interpret this better. And I'm sure there will be some correction that might take place and with the text of this proposal.
Right.
Yeah, I also had one more question here.
Yeah, go ahead, Swapna.
How would the interest also would need to be benchmarked with some logic? So would it be a Indian PLR or a LIBOR based or a foreign?
My guess is, they are going to come out with some rule around this, and knowing what the officers have done in the past, when you look at overdue data and all where they were applying PLR, the rule may prescribe PLR, but the courts have talked about, LIBOR or the internationally prevailing interest rates. So, yeah, if it is part of the rules, I think the only way you can dispute is by filing a writ. Otherwise, then it becomes a part of the law.
Very interesting. Just last question on this point. And then we will move on to the other areas. The secondary adjustment was carried out even in case of, I think, the Vodafone transfer pricing order, which eventually went before the High Court. High Court at that time ruled that there has to be first income, and only then transfer pricing provisions will apply. Naturally, court did not get into the secondary adjustment matter at all. Do you think that that basic fundamental principle for TP to apply, there has to be income? Is there any scope that that principle might get revisited post this amendment? Vijay?
No, I don't think so. I think that that principle remains. There has to be a primary adjustment, and the primary adjustment is linked to the definition of transfer pricing, which says that income in relation to international transaction has to be computed with reference to the arm's length price. So that income reference in that 92.1 will continue to prevail. So there has to be income before primary adjustment happens, and only if there is primary adjustment, secondary adjustment happens. I think we are safe on that as of now.
Vish, do you agree with this view?
I agree with that. And that is the logical way of looking at it. I don't think there is any other way.
Yeah, absolutely. Moving on, the next big change, some call it as a interest deduction limitation rule, some call it as a version of thin capitalization rule. Clearly, I would prefer to refer it as interest deduction limitation rule, which is sort of taken from BEPS Action Point 4. And this particular amendment is also very interesting. Swapna, can you quickly take the audience and lead us through what this proposal is, and then look at some of the issues that arise from it?
Yeah, sure. This particular provision is section 94B, which is getting inserted, where Indian entity or a PE of a foreign company in India borrows money from its associated enterprise, where the definition of AE is same as under transfer pricing, and the payment of interest on such borrowing exceeds 1 crore rupees. Under profits and gains of business or profession, then there is a cap on the deduction allowable, which is it cannot exceed 30% of profit before interest, tax and depreciation. They are covering two more situations in this case where this provision would become applicable. If there is a loan taken from third party for which a guarantee is issued by foreign aid, or a loan is taken from the third party, but equal amount of deposit is made by foreign aid with the lender. In those situations, also this provision would get triggered. Since there is a cap on deduction, the amount which is not allowed as deduction can be carried forward to the following 8 years and can be set off against business income later. That's the gist of the provision, basically.
Right. Which, on a broadly, if we compare, yes, there are lots of similarities with reference to BEPS, but there are some unique propositions as well. Your overall take on particular proposal, Vish?
I mean, I agree with you that while it is somewhat in line with the BEPS Action Plan 4, but BEPS Action Plan 4, to my mind, has provided a much larger leeway as compared to a watertight provision that is being proposed, right, where it talks about the group borrowings, etc. And the more draconian, to my mind, is when even there is a guarantee, right? So there could be even reason borrowing just to leverage and repatriate and take arbitrage of the ability to repatriate money in the form of interest instead of dividend. So I think that is a significant difference. Uh, and probably if you look at some of the companies which are borrowing, have like need to convert them. There are
Vish, your audio is not clear. Hello, we lost you for last few seconds.
So what I'm saying is, this is much more draconian. Even if a guarantee is provided by the AE, then still it would fall under the mystique of this law. So, which is again too narrower as compared to BEPS Action Plan 4. And there are quite a few companies which will be hit very hard, especially ones in manufacturing and infrastructure space. And especially and more particularly the ones in infrastructure, they may not avail that carry forward benefit of 8 years because if you look at the gestation period, the interest and all. So I think it is apt to make a representation at least to take out the guarantee related part from the coverage of this, so that and I think it needs a little more thought through mechanism to say when you will disallow that interest. If even the parent is highly leveraged, then there is no reason why you should disallow that, because if they can borrow at a lesser cost, taking the exchange fluctuation impact, etc., and if that benefit is being passed on, why should these companies be forced to borrow locally or at a higher cost? So I don't think that it is making sense to certain extent.
Right, Vijay, your thoughts?
No, so I agree with that point, that clearly the guarantee aspect. So if you look at the economic substance of that, I don't agree with this concept of bringing in the guarantee. So you are virtually forcing the Indian taxpayer to borrow without a guarantee because you don't want to fall within the cap, which may be slightly more expensive. So you need to do an evaluation, and you might evaluate and say that there is some incremental cost of borrowing if I were to borrow on my own without a guarantee, which will give me a deduction in spite of the fact that I may not have enough EBITDA to cover this. So that evaluation may result in higher cost of borrowing so far as India is concerned. That kind of doesn't give us good economic answer. But if I look at the thin capitalization principle around the world, it kind of fits in because they have a similar mechanism of saying that they will look at loans provided by the AE and loans guaranteed by the AE, so both will be covered. So in that sense, it is aligned. But one aspect which is exceeding even that aspect is this reference to an implicit guarantee. So it talks about explicit and implicit. I don't think implicit makes any sense because implicit is just in someone's mind, and that can never be proved either way. So the TPO will say, I think because you are part of this very big group, there is an implicit guarantee that your debt will be supported. And you will say, no, so there is no such legal binding. My AE may never support and I may default. So that leaves us with a lot of scope for challenges. So I think we should take off the implicit reference. The explicit part, if it stays, will only mean higher cost of borrowing. But otherwise, I think it does fit in with the thin capitalization concept.
Right. And the if you look at the specific formula, the computation, it talks about 30% of EBITDA, and what you need to compare is the total interest, which presumably includes even a third-party interest or AE interest, whichever is higher. Do you think this provision is logical, or perhaps is a bit too harsh?
Yeah, it's a bit too harsh. I think they should first of all have used the concept of a net interest because you may have corresponding interest income as well. There may be some kind of securitization and so that you may be also putting in. So the net interest concept is what is more appropriate, and that would leave us with a smaller amount to fight out. So that I think clearly should be looked at, but that gets into too much of detail, and I'm not sure how much they will be able to accommodate at this stage. But from a conceptual point of view, net interest is a better concept.
Right. Which the exception that has been carved out is right now restricted to banking and insurance. Any other sectors you wish should have been there, or you think the exceptions are fair in the context of Indian system?
I see it makes a lot of sense to exclude banking and insurance sector from this. But if any other industry is excluded out of this, I guess it is not a level playing field, I would say, because from a principal perspective, it should apply to everyone. Again, I'll go back to this point where if the foreign company is charging a guarantee fee, a transaction, borrowing, I think,
Wish we are losing your voice again.
while it is, when the Indian entity pays a guarantee fee, and that it's at arm's length, then why should there be any additional disallowance on account of interest if it is paid to a local financial institution? So I think while Vijay referred to implicit, but it is both explicit and implicit. The guarantee part, if it is removed, I think it makes sense from an economics perspective.
Right. And one quick question around this: when there is a AE interest, there will be benchmarking from a transfer pricing point of view on this AE interest, and then thereafter again this 30% threshold needs to be applied. Do you see any tension between the two provisions, Vijay, emerging as the interpretation evolves?
No, so I think it would override arm's length. So even if you are at arm's length and you don't have enough of profits, it will disallow that cost and will carry it forward for the future. So it is allowability in that particular year may not be an arm's length charge, but the overall charge that can get carried forward will be a measurement based on arm's length. So arm's length and both will survive, but the deduction in that particular year will be based on the 30% threshold.
Also, economically, it may not be, or financially, it may not be a viable proposition, because there is a withholding tax on this. So the entity would pay withholding tax, and the entire amount in a way is taxable in the hands of foreign, and I get only part deduction, and I can carry forward this. But from a time value of money perspective and all, when you look at, I think doesn't make any sense. There are
Wish we lost your voice again for last few seconds. Uh,
Yeah. So I'm talking about the withholding tax and how it will make the entire proposition non-viable from a financial angle, because you would end up paying withholding tax on this, and also your deduction is delayed. When you look at time value of money, then you are losing out. And if ultimately if you are not in a position to take benefit of this carry forward interest, so it's a not a good situation. So
right.
therefore, yeah.
Yeah. Vijay, wish the third amendment pertaining to about domestic transfer pricing and the 48(2)B references have been removed therefrom. Any quick comments on this particular amendment?
Yeah, I would say it is the most welcome move in this finance bill from a TP perspective, because otherwise, it's unnecessary compliance which is not leading to any advantage either for the taxpayer or for tax administrator. And
Vijay,
English issues get away, just like benchmarking a director's compensation, etc.
the fine print correctly, Vijay, if I read the fine print correctly, this particular removal is applicable from current financial year, that is FY 16-17. Is that right?
Yeah, that's right. So
Right. So that in fact is it helps in the current transfer pricing season as well.
yeah, so I have one other point on this, that 48(2) still survives. So
Sure.
so then I think they should have got rid of 48(2) itself, but to leave it there with the AO now. What has now transpired is that, of course, 48(2) was something which was somewhere there and was invoked maybe once in 1,000 cases.
Right.
Then suddenly it was in the limelight for the last 3 years, and it went into an assessment this year, and there were cases of 48(2) which went through assessment, and all sorts of observations were made. Maybe no adjustments were made, but at least it brought 48(2) into the limelight. Now to leave it in the AO's hands without TP being there, I don't know how much it will serve, unless there is particular guidance to say that the base erosion concept should be looked at. We've had cases where 48(2) has been invoked in loss-making entities, where the loss-making entity is the one which is receiving the income and is receiving a slightly higher income, and the one which is profit-making has suffered an adjustment under 48(2). Now we are back to the old days. If 48(2) doesn't come into the radar, it's great news for everyone. But if it is now in the radar and without TP principles being there, then probably we are slightly worse off. So our representation to the department has always been to take out the director's remuneration from this and to take out 48(2), but not leave 48(2) in the hands of the AO. That I don't think is the best answer for the taxpayer.
Right. Very interesting. So three significant proposals. Clearly, the secondary adjustment, some significant impact areas, and lots of issues to be clarified. Same is the case with the interest deduction limitation rule, and that brings us to a larger question, Vijay and Vish. We are barely a few weeks away from the Indian GAAR, which will kick in from 1st of April 2017. In light of that, we have these two specific amendments, sort of anti-avoidance amendments. Last week, we had a circular from CBDT wherein they said that SAR and GAAR can coexist. If you put all these things into a broader perspective, so you have a transfer pricing which is a specific SAR, and on top of that, all these transactions can also be viewed from a point of GAAR as well. Any comments? Your thoughts, Vijay?
Yeah, sure. So I think that is the general principle, that GAAR will be looked at parallelly with SAR. So I think that remains a challenge. That is how it will be implemented. So because you have an arm's length price, doesn't mean that it is all above board. whether the structure was designed in a manner to avoid taxes will still continue to be an overriding question to be answered. So apart from answering the arm's length price for a transaction, you also have to justify the business substance. So that is the new world, I guess, and we have to continue with that kind of an approach to look at the substance of it over and above the arm's length purely. So I think clients are already looking at it, and they're evaluating whether any of their structures is something that can be challenged under GAAR, even though their pricing may be appropriate. So looking at depths and looking at arm's length, uh, I think it largely, we know the answer on how do you prove substance and how do you prove that you're not avoiding tax and there is no willful avoidance of tax. But I think there will be still some open questions that will keep arising as we go along. But my guess is looking at Action 8, 9, 10 and looking at transfer pricing, arm's length in general, we should be able to address the substance question.
Wish, your advice to the taxpayers with GAAR just being away by less than 2 months?
Yeah, I think obviously transfer pricing operates in specific arena, and the GAAR can also coexist, as Vijay said. Obviously, with the PEPs coming in place, substance is going to be the key. And even though you may say that the transaction is at arm's length, but if that arm's length determination is taken into account the substance by looking at the functions, assets, and risks, right? If your analysis is right, taking each of these, and in a way you are also considering the substance, perhaps you would be better off. But if you just say, oh, I'm only looking at from arm's length perspective, but the structures and I'm leaving it to someone else, I think they still have a problem. Even on transfer pricing, you might be fine and you are compliant.
Right. Wish, one last question. BEPS Section 8, 9, 10, you think we should expect a few more proposals, maybe via rules in the coming months?
See, I guess it would be more of, see, as far as the legislation is concerned, I think the moment when you look at what we have as a framework and the thought process of the tax administration, even before all this, or even while under discussion, you had this circular relating to profit split method, which was later on taken back, and you have circular on R&D centers. So therefore, what I believe is these are already in place. Perhaps what is the need of the hour, based on the BEPS action plans, more guidelines or
No, we can't hear you. We couldn't hear you.
better now?
Yeah, better.
Because I cannot connect any external device to this. That is the problem.
Yeah.
So, sorry, let me just repeat it. So, what is the need of the hour? Once you bring in all this and the tax authorities have been that their positions are through after the BEPS action plans, the government should come out with some guidance to the taxpayers as well as the tax administration, so that you know what exactly you need to really do. I think the guidance.
Wish, we are losing your voice. Sorry, Vijay, I think the key part of Wish was that some more guidance should perhaps come through. Vijay, your take, do you expect some more rules to come through in the next few months?
Yeah, I think so. So there are a couple of things that need a legislative amendment. For instance, the definition of intangibles, I think, is different in, slightly different in Action 8 as compared to our domestic law, which will have to be changed. So there may be a legislative amendment required there. and there will be others where there will be a notification or a circular which will have to come out as to what part of Action 8, 9, 10 India is adopting. So that without adoption of that, it doesn't become Indian law. And we will be fighting it in the courts to say whether this is binding, whether this is persuasive. So all sorts of things will come up. And I think the government is very clear that they will come up with guidance on what part of that they're adopting and how they interpret it. Though, of course, as transfer pricing people, we would believe that the concepts which are set there are any case applicable whether you have a specific guidance or not. But we looking at the lawyers fraternity, I would believe that these things will become contentious. So it is better to formally adopt it and bring it into our purview of law, and it becomes Indian guidance as against an OECD guidance.
Right, right. So both Vish and Vijay are saying some more guidance is required. Perhaps that might come through the rules. Thank you so much, Vish, Vijay, for your time and insights. Thank you so much, Swapna, for adding those perspective and pointed questions. It's been wonderful interacting with all of you. Dear viewers, if you have any questions, please leave them in the YouTube link below, and we'll try and get back to you with some more clarifications as well. Thank you so much for everyone for your time.
Thank you.
Thanks.
Thank you.
Thank you. Thanks. Bye-bye.
Thank you.